you called this the worst energy crisis of our lifetimes and said the level of complacency is astounding. Why is this so bad? What are we missing?
Well, I think what the market is missing is the West is really yet to feel the true impact. When you read stories about product hoarding, you read about operators of gas stations being shot dead because they ran out of product in India and was unable to fill up cars. You hear about fishing boats in the East not being able to fill up because the economics of going out and fishing just don't make any sense. We see the world through a Western lens, and yet this is a global crisis. When you think about the true impact, like the Strait of Hormuz, people may say this now, but no sober mind ever thought that it could ever actually be impeded because it was just too critically important. Roughly 22 million barrels per day of oil and product were flowing prior, which is obviously massive from a global context for oil. We know LNG, 20% of global flows as well. And so when you consider that global oil production today is down about 11 million barrels per day, it's forecasted that between barrels already lost and those yet to be lost, we will lose about 900 million barrels in Middle Eastern production this year. Contrast that to COVID, the biggest demand shock in history, and demand fell about 870, 880 million barrels. So it puts things into perspective, and yet the market remains very, very complacent, both on the near-term impact and also the long-term impact of it. Okay,
so let's talk numbers here, because GLC Go on the Bloomberg terminal, I look at global commodities right now. Brent, 114.37, WTI, 104.10 right now. What prices should those be to reflect what you say is this supply shock?
Well, let's walk through where we're going. We can answer the question more intelligently. And so where we sit today is there are safety buffers that are being used up in real time. We've had the unsanctioning of Russian barrels, floating storage. We've had the unsanctioning of Iranian barrels. We have a very modest SPR release globally, but it's all a rounding error relative to the context. And so it's just as those safety buffers are used up, and you hear more and more about actual physical shortages, like it's not going to be a matter of price. It's a matter of is the barrel of jet fuel, is the barrel of oil actually available? That is when I think you will see a bridging of the paper market and the physical market. The paper market we know is 50 times bigger. It's been suggestive that perhaps at least in the WTI market, the invisible hand of government may or may not have been involved. In terms of where we're going, if the strait does not open and we need to kill demand, past scenarios would be when about 5.5% of the global economy, global GDP, is being spent on oil. That is when the onus is too great and you see real demand destruction. That, in today's measurement, would be about $177 per barrel. That is where we're going if the strait is not opened.
All right.
Wow. Ifs 77.
A lot of ifs, though, right? And this is where we are. And this is what makes it so difficult to kind of figure out short-term versus long-term impact. At this point, how are you advising investors to position within the energy patch? That this is a longer-term problem and situation, or no? And I'm just curious what you're hearing from those players in the energy, whether it's the E&P space or whether, whatever it may be. Are they ramping up because they're seeing that they're going to have to meet demand because of the destruction in the Middle East, or what? Like, help us kind of figure out the picture here.
You bet. So energy investors should never buy energy stocks based upon a geopolitical spike. What I'm really focused on is what I call the day after. The strait is going to open. It's just a matter of time and the assets required from either the U.S. military, whatever coalition is forming. It has to be opened. And so what does the oil market look like? What does the energy market look like after that? What I think people are not understanding is coming into 2026, it was anticipated by most that we were facing the biggest glut in history. That is no more, just given how much oil production we have lost and in the read-through that is having on inventories. By the end of this month, we will be approaching multi-year low levels from an inventory perspective. The second is I think there's going to be the introduction of a permanent political risk premium in the oil price of at least $10 to $20 per barrel that is enduring, because the market's focus rightfully should be on, OPEC spare capacity. We thought coming into this event was about 1.5 million barrels per day. Much of that was behind the strait. Saudi Aramco, through Herculean efforts, have increased exports out of the Red Sea. But again, that's a rounding error relative to the total impact. And so, it may be true that OPEC has spare capacity, that's that safety buffer, but in the future, it can always be impeded once again with a mere $30,000 drone. The last impact, I think, is on actual curtailed production. I mentioned we're down about 11 million barrels per day. It's going to be country specific. Kuwait said it will take 3 to 4 months for them to fully ramp. There's a lot of concern in Iraq, which has gone full force majeure, that there's over 1 million barrels per day of production that could be subjected to the below surface reservoir damage. And so the fear is maybe there's permanent or semi-permanent loss of productive capacity whenever this comes on. And so, this notion that the Strait opens up, oil falls to $60 and energy stocks fall, I really think is naive. The past is not going to equal the present, and there's no new normal. There is in fact a new normal to go to now.
Is part of the new normal going forward, though, a hostile Iran going forward and a Strait of Hormuz that is maybe problematic? Or do you think after this is resolved and whatever that looks like, that it is a place where there can be safe passage of vessels?
I think you'd have other guests who can more intelligently pontificate on that. I think it's clear that Iran it has weaponized energy. It means that the most critical strait for flows for LNG and oil on planet Earth are now a lot riskier than before. And so that's why I think at least a $10 to $20 political risk premium is relevant and likely. It also places emphasis, I'll be accused of home team advantage here, but being in Canada, but those countries with long dated reserves in politically secure areas with adequate takeaway capacity, I think the value of those reserves have become wildly more valuable.